Welcome to August Metal Movers. I'm Shirley from the Nickel team and this is Candice from Aluminium.
Hi.
In today's episode, we'll be taking a closer look on the recent developments in the nickel and aluminum markets. Focusing on Indonesia, the nickel market has undergone significant changes since late last year, driven largely by policy shifts in Indonesia and rising geopolitical risk. Nickel prices started the year on a stronger footing, moving up to around $16,000 to $17,000 per ton, compared with around $14,000 to $15,000 per ton levels in 2025. This was supported by growing concerns over supply. Prices continued to trend higher through the first quarter, reaching an almost 2-year high near $20,000 per ton in April amid tightening conditions. This price strength has been underpinned by tightening supply across the nickel value chain, including nickel ore, nickel pig iron, or NPI used in stainless steel production, and mixed hydroxide precipitate, or MHP, in battery production. Starting with the upstream market, nickel ore supply has tightened considerably this year. This comes after Indonesia reduced its work plan and budget, or RKB quota, to around 270 million tonnes this year, which is roughly a one-third cut from about 380 million tonnes last year. Market participants have raised concern about the scale of this reduction, as estimated demand in 2026 sits closer to 330 million tonnes, implying that there is a potential supply shortfall. Because of the reduction in overall RKB quota, Weda Bay Nickel, the world's largest nickel mine, has also experienced a significant cut in its RKB production quota this year. The allocated quota was set at 12 million tonnes, which was a sharp drop from the 42 million tonnes allocated last year. The mine has now moved into care and maintenance after fully utilizing this reduced allowance. Operations are effectively on hold for the time being, as the company awaits approval for revised quota, which is expected to come through in the third quarter. Moving downstream to MHP, some producers have curtailed output due to margin pressure, with reductions reportedly in the 30 to 50% range. This is driven by a double cost squeeze of higher ore prices and rising input costs, particularly sulfur. Indonesia's HPAL sector relies heavily on imported sulfur to produce sulfuric acid, and disruptions, including geopolitical tensions affecting major supply routes, the Strait of Hormuz, have driven costs higher. At the same time, revisions to Indonesia's HPM benchmark pricing mechanism have further increased feedstock nickel ore price. The HPM pricing now includes cobalt, iron, and chromium. As a result, the prices of limonite ore used in the HPAL process to produce MHP has increased sharply, putting additional pressure on margins. In the NPI segment, supply has also tightened. Lower ore grades combined with better economics for nickel matte have encouraged some RKF producers to shift output away from NPI towards matte production, reducing high-grade NPI availability. Overall, tighter supply across nickel products in the first half of the year has supported prices in the range of $17,000 to $19,000 per ton, with periodic strikes on stronger market sentiment. Looking ahead, supply risks remain for the second half of the year, with additional policy uncertainty in focus. Indonesia is in the process of centralizing exports of key commodities through a new state-owned entity, PTDSI. The policy, which currently covers palm oil, coal, and ferroalloys, began a transition phase in June, with full implementation targeted by January next year. Nickel products are not yet explicitly included, and the market is still waiting for clarity on whether materials like ferronickel and NPI will fall within the scope. Separately, NPI supply from Indonesia's Weda Bay Industrial Park may also face additional supply pressure. Some NPI smelters have been asked to scale back production to conserve electricity and prioritize aluminium production, where margins are heard currently stronger. This is aligned with the government's direction, as aluminium is also at the forefront of Indonesia's policy change. It is a product that the government is eager to develop, given promising prospects and margins. Is this what you have been observing in the aluminium market, Candice?
Hi everyone, thanks Shelley. Yes, definitely. And I think this is a very interesting point. Both energy-intensive sectors are expanding in Indonesia. With nickel is already a very important part of the country's metal story, aluminium is also gaining more market attention now, especially as its margin have risen and new capacity continues to come online. As the industry knows, capital investment and electricity are probably the two biggest constraints for aluminium smelters. We need money to build the smelters, and we also need stable and affordable power to actually run it. If we look at the power first, aluminium production is really electricity intensive. For 1 ton of primary aluminium, producers usually need around or more than 30,000 kilowatt hours of electricity. So it's a huge amount of power. Nickel is also power intensive. So when both industries are expanding, power availabilities become really important questions. And that is especially true as Indonesia is bringing new projects online and existing ones are ramping up productions. Based on the estimation, Indonesia's aluminium output is expected to jump by about 84% on a year, taking total production to roughly 1.5 million tons. We also published an article late last year that breaks down the estimated output from each smelter there in 2026. But at the same time, producers now have a stronger incentive to move these projects ahead because aluminium margins are much higher than before. LME aluminium prices have been traded around 3,500 per ton recently, which is roughly $1,000 higher than a year ago. So that gives some producers a stronger reason to invest or speed up their expansion plans. Exports are also rising this year. For January and April, Indonesia's aluminium smelters has increased their exports by around 49% on the year to more than 220,000 tons. Turkey, South Korea, and Vietnam were among the key destinations in April data. But at this stage, Indonesia's aluminium stories is still mainly an upstream stories. Most of the development there seems to be focused on bauxite mining, aluminum refinery, and primary aluminium smelting. So I would say the direction of building up the entire aluminium chain is definitely there. However, Indonesia's role in value-added aluminium products is still something we need to watch over in the next few years. And if we zoom out for Indonesia and look at the bigger picture, another key driver behind the increased attention on Indonesia's smelters this year has been supply disruption in the Middle East, which tied to the US and Iran war. What we're seeing with the US-Iran war is basically a black swan shock for aluminium markets. The Middle East makes up about 9% of global supply, and disruption there have a real impact. And we have already seen that in trade flows. Japan is a good example. Its aluminium shipments from the Middle East dropped sharply in April. Flows from UAE were down about 87% compared with a year ago, and which was like from roughly over 10,000 tons to just over 1,000 tons. While shipments from Saudi Arabia were down by around 82% to around 400 tons. This tightness is clearly reflected in the ongoing quarterly premium negotiations for deliveries to Japanese main ports, which basically acts as the regional benchmark for primary aluminiums and related product sales in Asia. And for the upcoming quarter, production offers last we heard was about $445 to $470 per ton. That is a clear increase from this quarter's settlement, which was around $350 per ton. And the second quarter level was already coming strong at a level which up about 80% on the quarter and 90% higher than a year ago, which settled at $182 per ton. But I think the more interesting point is that since the current mechanism for settling QMJP largely reflects premium levels of Western origin aluminium, it has caused it to become detached from broader aluminium premiums. And if we look at Asia more broadly, actual supply is not that tight. Indonesia is still increasing output, and China is also sending out more aluminum stranded wire and other value-added products. And of course, Russia have been delivering metals to Asia continuously. So buyers in Asia markets still have alternatives. As we could see, Indonesia aluminium is gaining market shares in South Korea, Vietnam, and Thailand, but its shipments to Japan are still relatively limited. So, in a way, the market is tight, but it depends on which origin, which brands, and which destination we are talking about. Another thing to note is some of the new Indonesian aluminium brands still unregistered on the LME. So it's not deliverable into the LME warehouses. As a result, some participants would regard its influence on LME prices is still mostly false market sentiments. So looking ahead, we'll be watching three things closely in this region. How fast Indonesia's new aluminium capacity can ramp up, and whether power supply can keep pace with industrial growth there, and how far the country can move beyond upstream production into a broader aluminium supply chain. Overall, Indonesia is becoming a much more important part of the regional metal stories for both nickel and aluminium. That brings us to the end of this episode. Thanks for listening and stay tuned for more updates from Agus Media. You can find us on our official website and speak to a specialist about your specific interests across our commodity coverage.